So my name's Ryan. I've been kind of just doing a little bit of financial planning on my own, just looking towards retirement and kind of what sort of obstacles there are when planning for retirement. So we're just going to jump right in, and I'm going to say that this is, first of all, this is free advice, okay? And the most expensive advice that you'll ever get in life is free advice. All right, so I'm not licensed. I'm just a software engineer. It's kind of do it yourself. And so just take everything that I say with a grain of salt, but I just want to kind of present some ideas and let you think about them, go back home and research them on your own and, for your own financial planning, because everyone's situation is unique. Okay, so the first thing that I came across is fund fees. And a lot of this will be a review or pretty basic for most of you, but just wanted to call a few things out here. So fund fees. First of all, there's your advisor fee. So what you're going to pay your advisor if you have an advisor or choose to have one. That might be anywhere from 0.5% to 1.5%. Then there's trade commissions, and most of you are very familiar with trade commissions and how expensive those can be, especially if you're a day trader. There's also things called front end and back end loads. Okay, now those are sales fees, and they can be extremely high depending upon what fund you invest in. We'll get to some examples here in a minute. There's also administrative fees, management fees, redemption fees, and marketing fees. Those last few are all rolled up into something that's often called an expense ratio. So let's take a look here at a few different mutual funds that are common here. So let's see. All right. Okay. Let's see. Can you guys, let me present this over here. Oops. All right. I think what I'm going to do is actually just end the slideshow here. Okay. Can everyone online still see my screen? Is that okay? Yes, fantastic. Okay, excellent. Now, if I can get rid of this thing. All right, we'll put it down here for now. Okay, so here I am on U.S. News and on our mutual funds page. If we scroll the way halfway down, we'll look at the top, mutual funds here currently today. So we'll look at this one, this one from Vanguard, and we'll compare it to this other one down here, this international stock, the #1 international stock fund. Okay. If we look here at the Vanguard fund and we go over to cost and fees, and we scroll down, we'll see that, first of all, there's no sales fees. Okay, the initial and deferred sales fees is blank. There's no administrative fees or management fees. There is a management fee. It's pretty low. And we have no marketing fees. And then there's an expense ratio right here at 0.06 or 6 basis points. Okay, so over 10 years, if we were to invest $10,000 in this fund, it grows about 5% a year. Over 10 years, we'll have only about $77 in fees, which is pretty good, right? Pretty cheap. Compare that to this other fund. Look at cost and fees, and we'll see that there's an initial, remember this is one of the #1 funds in America, there's an initial sales fee of 5.75%. That's massive. So every dollar you put in, whoever sold you this fund or the idea of investing in this fund is going to get 5 3/4. Now the expense ratio is actually pretty low. It's 0.35, all right? Whereas the category average is 1%. A lot of that's marketing, marketing to those sales guys. But one thing to take a look at is this also shows you not only the current expense ratio, but what the expense ratio is going to be next year. So you might be in a fund and not realize that it's going to jump a whole heck of a lot at the end of the year. So if you're investing in funds, make sure you pay attention to the prospectus. But this gives you an example. The total cost of a $10,000 investment for 10 years is almost it's 1880 is what that number is right there. Okay, so that's a lot. That's dramatically different from 77. That's only for 10 grand. Imagine if you had 100 grand or $1 million invested in this fund, what that would cost you over 30 years. Looking online here. Okay, so nobody is seeing what I'm presenting. That is a problem. 1 second. All right, share my screen. Okay. Can you guys see it now? Yes, fantastic. Okay, great. All right. So just a recap for those online. This fund had a really expensive sales fee, and that fee, the expense ratio also is going to jump next year from 3.35 to 1.12, and currently it's costing $1,880 over 10 years. So you got to watch out for fees. So free advice is expensive, but so apparently is paid advice. All right. So Jack Bogle he's the founder of Vanguard, and he believes in low-cost mutual funds or ETFs. And his investment philosophy, there's Boglehead's wiki is develop a plan, invest early and often, never bear too much or too little risk, diversify, never try to time the market, use index funds when possible, keep costs low, minimize taxes, invest with simplicity, and stay the course. All right. So a very typical sort of long-term investment strategy using your 401k, et cetera. And so we're going to kind of evaluate this philosophy. And there's a link here for some lazy portfolios. Let's see if I pulled that up yet. There it is. Okay. So some that they recommended is 60-40, cut between a total bond and a total world stock. Another one is you can split it up between total bond, total stock, and total international, so U.S. and international, different percentages. So here's a 33, 34, 33. Could also do 40, 40, 20. There's also the core 4 portfolio, which brings in some REITs down here, et cetera, et cetera. So I'll leave this exercise to the user, or to you guys, to kind of take a look and see, just explore these and figure out which one works best for you. But these are lazy portfolios. You set them up, you develop your plan, you set them up, and you kind of just let it run passively and just don't touch it. Okay. So the priority typically is you want to fund your emergency fund, 3 to 12 months for your emergency fund of expenses, and then contribute enough to your work-based plan to get the full match. This is kind of their philosophy on the order in which you should fund things. If you pay off high interest debt, such as credit cards, you should do that next. Health savings account. Who here has a health savings account? They're fantastic, aren't they? It's like the only triple tax savings in existence. So it's tax-free going in. It's tax-free as it grows, and when you withdraw for any sort of health expenses, it's also tax-free. Can anyone think of any other triple tax savings shelter? A Roth is double tax savings. We'll get that next. Okay, so what I do is I never take money out. Once it goes into the HSA, I never take it out. So just that way it just continues to grow and grow. Pay your medical expenses now with after-tax expenses. Let's see here. Okay, so then it says, contribute to your traditional IRA or Roth IRA, followed by the remainder of your workplace plan, and lastly, to a taxable account. Now, the difference between, just a quick review here, the difference between traditional and Roth, I know you guys all know this, is traditional is pre-tax contributions, Roth is after-tax. Traditional grows tax deferred, Roth grows tax free. Traditional, there's a 10% early withdrawal penalty with very few exceptions. Roth, there's no penalty if you withdraw your contributions, not your growth, your contributions. Your traditional, you're forced to take money out, distributions at 70.5 years old. With a Roth, you're not forced to take any money out. And then there are age restrictions on when you can contribute. You can no longer contribute after 70.5. But with a Roth, as long as you're qualified, you can continue to contribute at any age. Okay. So which should you invest in? Well, monetarily speaking, they actually turn out to be the same. Like if you're in the same tax bracket now as you are when you retire, then it does not matter. So here's an example. So here I have, a Roth versus traditional over here, and two different ways we could do it. So I took 30 years here from 1990 all the way to 2019, and this is the actual annual return with dividends in the S&P 500. And here we have $10,000, and we're assuming a 50% company match. So, here's $10,000, or let's just say it's, it could even be 100% on the first 5%. If you make $100,000 a year, regardless, you get $5,000 of match. And then if, and only if, you take the taxable, tax savings and you invest it into a Roth IRA, then the numbers turn out to be identical. Okay. Similarly, if you put $10,000 into your Roth, maybe you have a Roth 401k at work and you get $5,000, which is contributed on the traditional side from your company. It always goes to the traditional normally. Then again, the numbers are the same. Now we're assuming the same tax bracket, which is a 25% tax bracket. And there's a question here. Isn't a Roth versus traditional a gamble on future tax rates? Yes, it is. It absolutely is. So you might be in a lower tax bracket or a larger tax bracket, or higher tax bracket when you retire. We don't know. So you might not have a house payment or mortgage, but you may have really high healthcare costs. You might not be, you might also have other expenses like taking care of your failing parent or taking care of your child that hasn't left the nest. I mean, you might have a lot more expenses and need more income, thus be in a higher tax bracket. It's not always guaranteed that you're going to be in a lower tax bracket. You just don't know the future. But you're right, it is a gamble. Okay, so let's take a look at maxing these things out. So the IRS says that you can actually contribute $56,000 to these qualified plans if you have like a self-directed 401k or something like that. So that's $27,500 over here, and then you put $19,000 in with your 50% company match. That's a total of $56,000. Same thing over here. If you were to max it out on this side as well, put the 19 over here with the 27.5, and then your traditional, there's actually a difference of a 10% over 30 years. So why is that? We just said they were the same. Why is that? Because you're actually getting more money into the Roth, right? You're actually paying the tax up front and putting more money in to the system. And so you have more money working for you. Right? So if you max these things out. Now, what some of you might saying, well, if I have this Roth 401k I can contribute to, well, can I just take the tax savings and invest it in a taxable account? And you can. And that's what I've done here. So if you were to take the tax savings that you contributed to the original 401k and put them in to a taxable account, then here you are here. The way you get this money in to both is you have an after-tax mega backdoor, Roth conversion. That is possible with some companies will allow you to do that. And if you set up your own, you can do that as well. If you're self-employed. So it's actually still pretty close. We're only talking about 1.35 here difference, $100,000 over 30 years and you make 7.5 million, okay, versus 7.6. So again, there's just really it's the this thing that's taxed at the capital gains rate here at the very end, which gets you, and that's why there's a difference. All right. So moving on. Okay. Now we're going to go through a couple of different investment calculators. The first one I want to draw your attention to is this Fidelity's X Factor. All right. So this is I think a fantastic calculator. It's really simple. If you want to share this with your family or your friends, I think it's one of the simplest things to understand. So let's just assume that the individual, for our example, is 35 years old and they want to retire at age, let's just say 65, and they're their lifestyle is going to be about average, not below average compared to today, not above average compared to what it is today. Let's take a look at the results, okay? So this is an X factor based upon your current income. This is saying that 2X, your current income, is how much you should have in savings to be on track, all right? So suppose this person made 100 grand a year, they should have 200 grand at 35 in savings. When they're 40, they should have 4 times, or 400,000, 600,000, et cetera, all the way up. That should be their target goal for how much they're saving towards retirement in their tax deferred or tax-free plans. Okay, and you can adjust these and see how it changes the strategy. All right. This actually, so what assumptions are being made here? Here's some information which you can go through, but this is assuming average return since 1926, I believe. It's also, there's something in here about inflation. Yeah, there's 1926. And you can kind of go through all the different assumptions. From what I've found, it's actually pretty good. Got another question online. There's a much bigger assumption here. Economic social conditions stay pretty much the same. There are scenarios where all those calculations mean absolutely nothing, and unfortunately those scenarios are with each passing day less and less unthinkable. Yes, let's talk about that. Okay. So here we're gonna run through a couple different simulations here. So let's suppose our individual, I know this is small for you guys, and I'm sorry I can't make this any bigger, but feel free, I want you to download this calculator and try this at home. I'm gonna try real hard to read this out loud. So if suppose we're 35 years old, we retire at 65 with life expectancy of 95, and this particular individual has put $10,000 a year into their tax-deferred account with a $5,000 company match, total of $150,000 over 10 years. Started when they were 25 and now they're 35. So again, they're basically $15,000 a year goes to this tax-deferred account. All right. If we were to kind of run the numbers here and run the simulation, okay, this is only an 80% probability of success. All right. Now this is looking at 10.7% returns with a 7.2 standard deviation, with an inflation of 2.5%, assuming a 25% tax rate and a 15% capital gains rate. All right. And again, we want to just have $100,000 at retirement per year. It also assumes, the current Social Security, Social Security is going to stay the same. $30,000 a year is at age 67 is what the government will grant you when you retire. So the nice thing is you can play with this. You can say, well, what happens if I get no Social Security? How will that affect my my probability of success? That might happen. You may actually just get pushed out to age 70 before you can take that full amount instead of 67, or you may only get half. So you can play with Social Security numbers. The other nice thing is if we come in here to our assumptions and we look at this compound, basically the average return and the compound annual growth rate of the S&P 500, we can calculate, well, from 1985, it's looking like 12%. A lot of these calculators assume 12%. So in 1926, they assume 12%. So that's what it is. But what if we're looking at our current calculation, 1990, where there's that 10.7 with a 7.2 standard deviation, which I have here, okay? But we all know it's 1990, there was a big boom, right? The tech boom. So what if it's more like the last 20 years? We're now assuming an average return of about 6.4 with the same standard deviation. So let's just round up to 7, since I think 7 is kind of the common number that is passed around. 7% average return. We now go from or basically it does not work at all. We now go to a 26% success rate, and our system is failing. Yes? Per year, yes. That's right. Okay. Yeah. The 100,000 is what you're taking out per year. Right. That's what that number is exactly.
So there's no earnings into this portfolio then that you can offset that total withdrawal. Is that the assumption?
You mean after retirement? Yeah, there's
Yeah.
no additional income coming in outside of
And
the
there's no
portfolio.
earnings on the portfolio.
Well, there's earnings. You're still earning at this rate, 7% a year is what this
Okay.
assumption is. And with the standard deviation is 17.2.
Thank you.
Okay. So let's just see if we can do any better here. Let's now take a look. I also wanted to, yeah, so 7, I think, okay, I think those numbers are correct. Okay, so let's just say, well, let's just do, let's just try the Roth, right, as opposed to here. And we see now that our probability of success does go up. It's nowhere near successful. So we need to start maxing this out, right? Let's max out our 401k, and we'll get the max. Let's just assume that $5,000 is the maximum company match that we can get. And we're still not anywhere near success. So we need to start putting like a lot of money in here, $50,000 into a taxable account. Okay, and we're finally over 90% success. So that's basically a $60,000 difference from what we were currently saving in order to be successful. That's assuming a 7% average return. Now, if we started saving earlier at age 25, these, we would have more money into our portfolio. But we just don't know what the future is going to hold. And so it's best to be very conservative with these numbers. Same thing with inflation. Right now, inflation's around 2.5. What if it goes to 4%? What does that do to our portfolio and our probability of success? What's nice is you can also come in here into additional inputs, and you can say, what if there's a crash at a certain date? What if there's a crash, at age 65, right before I'm about to retire? You could also adjust your Social Security. You could adjust your cost of living down here. These COLA types down here. This is a free retirement calculator online, which I provide a link to in the slides. And so I'll make sure that you guys all have access to this. The other neat thing is you can do Monte Carlo, you can do sensitivity analysis right here. And you can pick different portfolio returns with ranges. So here we can say that our annual spending is going to be between $40,000 and $90,000, and maybe the portfolio return is going to bounce somewhere between 3 and 12, and you can run through all these analysis here, and it'll tell you where things start breaking down based upon your parameters. Okay, I'm going to go ahead and stop that. So take this calculator, go home, use it for yourself, and see if you're healthy or unhealthy, and you might. I found that I needed more income to save more for retirement. And so this person here would have to do the same. Interestingly enough, if we go back here to this initial calculator, they assume a replacement target of 45% of annual income. 45% is probably because you don't have a mortgage, but B, you're not contributing anymore to your 401k. You have to contribute a massive amount in order to be successful. So once you retire, you're no longer contributing, and maybe you can live off a smaller income. All right, so is there another way? There might be. I don't know. Let's find out. Okay. Is the answer indexed universal life insurance? So for those of you who have never heard of Index Universal Life, it's basically you can contribute unlimited contributions. It grows tax deferred. There's a downside cap of 0 or 1%. There's an upside cap, usually around 12%, 15%. There's annual premiums that provide a tax-free permanent death benefit. And then the cash values can be used towards your premium. You can withdraw the cash value at any time without penalty, and you can actually borrow against that tax-free you can borrow against that cash value tax-free, but then the interest actually still accrues. So it's almost like a loan from the insurance company, which they'll get their money back once you die. But your interest still accrues. So let's calculate that. Is that better than a Roth? Let's find out. So, all right. Okay. So over here is kind of one of the typical plans. So Index Universal Life, I'm taking the $46,000 over here, and I have first of all, you lose out on dividends. So we're no longer making dividends in the market. They don't give you those. So dividends is usually around 2% for the S&P. There's also this thing called a participation rate, and the participation rate is just kind of taken off the top. It changes every year. It's based upon the insurance company sets it. I'm not sure the calculation they used for the participation rate, but typically it is anywhere between 80 and 90%. I left it here at 85. Here's the caps. This particular plan has a downside cap of 1%, so you're guaranteed to make 1%, but then they also cap you at 15%. So when the S&P makes 30% in a year, you lose out on that other 15%. And of course, there's fees, 1.5% management fees coming out. It's kind of a front-end load here, taking out of all the money you put in. And notice that the return is dismal compared to the Roth. It's literally $2 million less money over 30 years. So what can, maybe you find an amazing guy who takes all the fees out. Well, that doesn't really change much. Maybe your participation rate is 90% instead of 85%. Well, that doesn't really do much. Maybe your cap is higher. Potentially, that might work. No, I mean, that still doesn't get you there. I don't know. And usually you're not going to find something that's 18%. So can we do this on our own? So let's try to model this using our own money rather than going through an insurance company. We'll assume we actually get the dividends, and it's 100%, right? And we're getting 100%. We're not capped there, but we also take 100% of the loss, right? And there's no fees, and let's just go ahead and blank that out. Okay, so now we're at 0. So these numbers are the same. So if we were to buy some protection, let's suppose that it cost us, 1% a year in our account, and we can cap our returns at 10%. I don't know if that's possible. There's lots of different ways you can, buy volatility products to create protection. Maybe it costs you 1.5%. This formula might work. It costs you 1.5% of your account, your total account, to basically cap your downside risk at 10%. You might do, 10% better in the long run. Maybe if it costs you a little bit more to cap it here, maybe it costs you 3%. Well, you're actually going to do worse. So you have to be really careful. Maybe if there's time at the end, maybe we'll go over some of the various strategies you might be able to use to protect your portfolio. Any questions before I move on? What kind of protection? Well, you could just buy a simple put. You could buy puts, I don't know. You could buy fixed futures. You could work options on those futures. You could try to time your maybe don't have volatility, maybe don't have protection on all the time, just under periods of extreme risk based upon some sort of formula. There's many different ways we could do it. That's kind of beyond the scope of this topic tonight, but I think it's something that we should delve into eventually. Okay. So now there's a different philosophy, or another philosophy. So Robert Kiyosaki is author of Rich Dad, Poor Dad, and he says, don't work for money. Have your money work for you, or have your employees work for you. Learn the difference between a liability and an asset. So basically, there's a lot of risk in saving in this way. It's difficult to model. It's difficult for us to have a conversation about it. 30 years is a long time. So he basically says, instead of working for money, try to build assets, and those assets can generate passive income. Many of you are generating, using your portfolio to generate income. That's a form of investing. And he says, decide instead of becoming a B or an I, and decide to become a B business owner or an I an investor instead of an E employee or an S specialist. All right. And know the difference between liability and asset. Liability takes money out of your pocket, and asset puts money into your pocket. So he says, formulate an investment plan, increase your financial literacy, study. This should be a lifelong learning process. Most importantly, control your cash flow. If you buy an asset, make sure that it's putting money into your pocket, not taking money out. Build a team of experts around you and focus your efforts. So I have started looking into real estate investment, primarily because my wife is a real estate agent and she's in new construction as well. But I think anybody can play this game. So real estate investments has a lot of advantages, and we're going to model that here in a minute against the Roth IRA. So you have positive cash flow. There's appreciation, so the home is increasing in value. You're leveraging other people's money, so not only is the bank giving you a loan, and that's leverage, but you're also leveraging the person who's paying the rent. They're paying down your mortgage and your interest. Rents will tend to increase over time, and so but your mortgage is staying the same, right? So as a result, this is actually a hedge against inflation, right? So inflation is causing the rents to go up and the appreciation on the house, but your mortgage is staying the same. So it's inflation protection. And then there's a lot of tax advantages. All right. So some of those include, you can write off your mortgage interest. So interestingly enough, the Trump tax plan was great for real estate investors, as you might have imagined. But it wasn't so great for just, your average employee. So there's now a cap on mortgage insurance. You can only write off, I think it's $750,000 worth of debt, mortgage insurance debt. Home equity line of credits, you can no longer write those off as an employee, as a W-2 earner, but you can as a real estate investor. That's a way to get your money back out of the property after it appreciates or after a few years and the rents go up. You can just take a home equity loan and get money out and reinvest it. Property tax and insurance, you guys know there's a cap on that now as well, but there is no cap for a real estate investor. There's something called depreciation, where you can depreciate the value of the home over a certain number of years, and we'll model that in a minute. It's 27 and a half years, and it equates to about 3.6% tax savings on your home per year. Then you can also do these complicated things called cost segregation, where you're separating out the different components of the home and the value and actually writing them off faster. There's 1031 exchanges. Yes?
You seem to have switched from investment property to residential ownership property. And, the analysis is different depending on which you want to deal with.
That's right. Yeah, I'm specifically talking about real estate investment properties where you have positive cash flow coming from rents.
Well, then we can't talk about writing off the mortgage on our own property, which we're living in.
That's right.
Okay.
Yeah. I'm telling you that there's been a stark difference between who was able to take advantage of this previous tax law that just passed in 2017 versus, basically the professional real estate investor gets a lot of perks and the average W-2 wage earner loses out. The homeowner, yes. Yep. There's also 1031 exchanges where you can roll all of all the money, the appreciation value or the equity in your home. When you go to sell it, you can roll all that equity into another home, another piece of real estate investment property, or multiple, and avoid taxes. Otherwise, you're taxed at capital gains rates. If you do ever show a positive income on your tax return, then Medicare and Social Security is actually, you don't pay that on rental income. And lastly, there's a new 20% tax through deduction. There's a ton of tax advantages with real estate. So let's bottle that out. Okay. So here is a down payment of $50,000, sales price of $250,000, and the rate of return here is 5% for the mortgage. I'm sorry, not the rate of return. That's the mortgage rate. Mortgage $200,000. There's your payment. And so we're assuming that in the current market that the rent is around $1,500, and that gives you a positive cash flow of about $100. Now, what does that look like from a tax perspective and appreciation? So if it appreciates around 4% a year, you get to take, there's this thing called depreciation where you depreciate the value of the home over several years. So you have $7,000 you depreciate every year, along with your mortgage interest, and then also your property taxes and insurance. And that the very first year you have $17,000 worth of deductions, but only $1,000 worth of income. And so you can actually, depending upon how you set things up, you could actually take this tax deductions and write off some of your other income from your W-2s or whatnot. If you're actively engaged in the rental property. So over time, what is the end result? So it's about $1 million over 30 years. Now, that's if you don't pay capital gains rates, but if you did pay capital gains rates with depreciation recapture, which is a complicated formula down here, it's still over $1 million. Instead of 1.1, it's just 1 even. And we can compare that to our original investment over here of, basically over $50,000 with the company match, and that's about $800,000. So $800,000 versus $1 million. So over 30 years, it wins out. But there's more risk here, right? I mean, there's more work. It's not just set it and forget it. It's not you have to continuously make sure you know the market, make sure you get a really good investment. Just like you do in trading, you have to analyze the trade and get in at the right time. There's a lot of parallels. So let's pause for a minute and talk about for questions. Okay, is there any online? There is one online. Yes.
Like a real estate investment trust, as opposed
REITs.
to owning. Okay.
Oh no, you're
own-
asking about REITs. Yeah,
At one point I
that's
had
different.
31 units, and there's a lot. Like I always put 15% of the rents away for maintenance.
Yes. Yeah, you're right. So yeah, maintenance, there's some things that are not in this calculator here. And I have a more advanced calculator online, so maintenance is one of them. You're right. Another one is vacancy rates. And so I included another calculator here for this rental property calculator. And this goes into greater details where you can put in your vacancy rates as well as your other maintenance costs, your HOA fees, etc. So feel free to play around with that. All that you get to write off, yeah. So the way the taxes work, from my understanding, is that if you were to sell it after so many years, suppose you sold it right here in 2023, you would have to recapture some of this. But even if you weren't actively involved, like suppose you hired a property management company to do this, and you weren't, all you had, this is passive income. Passive tax deductions can only be written off against passive income unless you're a professional real estate investor, and you're materially, managing the property. So, but you can recapture that when you sell, as well. So things to look into. This book here, Tax-Free Wealth by Tom Wheelwright. He's one of the Rich Dad advisors. I've learned an awful lot. Also talks about stocks and paper assets, as well as gold and oil and commodities, and the different tax advantages with those as well. So let's I'm gonna leave you guys with some final thoughts here. So someone has asked, what about real estate in an IRA? So when you invest in real estate in an IRA, you're taking one tax, you're taking two things that are tax advantage. They're both tax advantage, and you're putting them together. And you actually could potentially owe money. You could owe taxes on your gains in the real estate. It's like two negatives equal a positive, right? And so you don't want to do that. You're also leaving a bunch of money on the table because real estate investing is very tax advantageous, but then the IRA is deferred, so any income you make, you're going to be taxed at ordinary income levels. Brokerage account in an LLC. Has anyone looked into setting up their brokerage account, their trading account in an LLC? No. All right. So are there any tax advantages of paper assets? Anyone know of the, options trading and that kind of thing? Is there any tax advantages of those? Well, there's capital gains, right?
The idea was the cost of having to create a business and the business taxes associated with it outweighed the advantages of just having your own personal little retail account. That the headaches could be just not worth the trouble and the advantages.
I got you. Yeah. And to a large part,
Big enough to absorb it so it's worthwhile.
Yeah, to a large part, that's correct. So I think there are not a lot of tax advantages to wrapping things up in an LLC.
Plus, Brian, I think you're going to lose the capital gains, the favorable capital gains, 60-40.
Can pass it through.
60-40 was the one I want to touch on. You want to explain how that works, Don?
Well, if you're an individual, you get the favorable treatment where no matter how short-term your certain instruments, such as widely held mutual funds and are traded, you can get 60% long-term capital gains treatment on those.
Mm-hmm.
I don't 40% short.
Yep.
Right?
Well, I was thinking about the options. If you're trading options, yeah, you're right. So 60-40. I think it's 60% is short-term and it's 40% is long-term. Yep. I think it's just options in general. And some people interpret it as futures as well, but I know options is definitely a part of it. Just on indexes? Okay. All right, good.
And also widely held mutual funds, which is a limited subset of mutual funds.
Mm-hmm. So now you can take advantage of all these tax-free, all these tax-free advantages are available to you as an individual. The only reason why I would think that you might want to roll your brokerage account into an LLC is for protection. So if someone were to fall down on your property and get hurt and sue you personally, they can go after your brokerage account and your life savings if it's in a taxable account. Whereas if it's wrapped in an LLC, it's much harder to get to. A lot of times people think of LLCs as protecting them from the other way, whereas if an employee tries to sue them, they can only get to the assets within their company and it protects their personal assets, but it also goes the other way. Yes. An umbrella policy.
An umbrella insurance policy, and then you don't have to go through the tax preparation costs of an LLC.
Yep, there are definitely tax preparation costs. What if they're trying to sue you for more than your umbrella policy, though? Get one for $5 million, yeah? Yeah, potentially.
There's another area which you may or may not want to address, and that's the issue of a trust.
A
personal trust.
Yep.
I have a trust for separate reasons, but I do not own my house. I do not own my brokerage account. I don't own my bank account. The trust owns all of those. The only thing that I own of significant value, and it's an old one, is a 2003 automobile.
Fantastic. Yeah, that's great. So that everything's in the trust and the trust is protected and you can control the trust, but your children will eventually inherit it and they have ownership of it, but nobody can go after it because.
Well, I think it's a lot harder to go after the trust than it is to go after me.
Mm-hmm. And there's this thing called dynasty trust too, So a normal trust can only last about 100 years for the lifetime of the person who set it up. But a dynasty trust can keep going generation after generation. That's great.
About the using the LLC for protection, normally you use a partnership for protection, general protection, lawsuits and everything. If you own an LLC, they can sue you and they say, well, okay, you have this money in the LLC and, give us that asset or, part of it or whatever. And
Yep.
so I don't think it's that good.
Yeah, my understanding is that you're right. A partnership, there is, if your partner screws up, they can come after you. But there's also this thing called limited partnerships as well, where you're protected. Yep. Or sometimes you can set up the partnership and it's passed through to the LLC. And that's another way you could do it. Yep. Exactly. Okay. Questions online. All right. Yes, there's a 20%. There is the requirement to qualify for the 20% pass-through exemption. You're correct. You should look into that with your tax advisor. Trading through an LLC may give you some of the advantages of trader tax status. Potentially. From what I understand, trader tax status is pretty strict. You have to trade over 4 hours a day, at least 4 days a week, and it has to be a substantial amount of money. You can't just do that with a $10,000 account. You have to just trade a substantial amount of money, and that will allow you to write off your expenses against your income, as opposed to just your trading expenses, like your commissions. You can actually write off things like your car if you're driving to some place to trade, etc. No. Options on cash-based indexes. Yes. Thank you. 1256 contracts are 40 short-term, 60 long-term. Okay, Don was correct. With the trust, you inherit a stepped-up value. Yep. Exactly. Yeah. When you pass away, that's the same thing with 1039. So there's this philosophy of 1031 of borrow and just keep borrowing until you die. And then when you pass those on to your heirs, they can be 100% tax-free. That's exactly right. Stepped up value. Okay. So lots of great ideas here. I think some of the things I wanted to just drive home. Oh, lastly, gold. So we talked, oil, there's some advantages to oil. The government basically is your partner if you were to drill for oil or mine as well and commodities. With gold, interestingly enough, the capital gains rate on gold is higher than the standard capital gains rate. It's in the 20s. So if you were to hold gold for, over a year, you go to sell it. So the government doesn't want you to own gold. They want you to invest in real estate. They want you to invest in the stock market. They want you to create jobs. They don't want you to own gold. So they actually penalize you there. But whatever your investment strategy is, create a plan, talk about it with your advisor, and also I want to talk about the power of leverage. Leveraging people, their ideas, their talent, their knowledge. In a way, that's kind of what we're doing here in this meetup. We're all discussing these ideas. We can leverage our talent and knowledge together, and we can use other people's money, such as the bank's money or the renter's money. And then there's tremendous power in velocity of money. So taking the money that your assets are generating and then reinvesting them year after year after year. That's how the wealthy truly build wealth. Hold a little physical gold for disaster and invest in gold mining shares. Sounds fantastic. REITs, someone mentioned REITs earlier. I did want to touch on that. You don't have the tax advantages with REITs as you do with rental property. There's also crowdfunding right now available for REITs. So you can, instead of doing one that's traded actively on the stock market, you could do one that's not through a website, and it's basically a crowdfunding type deal. And the tax implications are complicated because they will come in different brackets or different buckets where they might be taxed based upon if it's rental income or appreciation, etc. So, okay, anything else? Great. Thank you, guys. We're going to get prepared here for the next presenter.
Thank you.